Everyone keeps asking the same question. Is the housing market going to crash? But I think we're stuck in something different, a freeze. And if I'm right, this freeze could last well into 2026. Not because home prices can't fall, but because the system underneath housing has changed. In the next 10 minutes, I'll show you the real mechanism that's keeping housing frozen, why buyers can't buy, why sellers won't sell, why affordability doesn't reset quickly, and what would need to happen for the market to actually unfreeze. This isn't hype, and it's not financial advice. The goal is clarity, so you can make smarter decisions whether you're renting, buying, or already own a home. Keep it tight, don't overdo disclaimer. Most people think housing breaks in one way, prices collapse. But a freeze is different. In a freeze, transactions collapse. The market can look stable on the surface, but prices dawn to crash dramatically. But underneath, fewer listings, fewer buyers able to qualify, fewer people moving, and everyone just waits. And when activity dies, the entire housing ecosystem gets stuck. Agents, builders, lenders, renters, homeowners, all trapped in slow motion. On screen, simple graphic text. Crash, tornast, prices fall fast. Freeze, sales volume falls, plus mobility dies. Let's start with buyers, because this is where the freeze begins. Housing affordability is basically a math problem. Income, home price, mortgage rate. If mortgage rates stay elevated, affordability doesn't just get a little worse, it collapses. So even if prices stop rising, if rates stay high, your monthly payment stays painful. That's why buyers don't rush in. They either get priced out, pause and save, or rent longer. Key idea: high rates don't just reduce demand, they create a psychological barrier. People don't want to lock a 30-year decision at a payment that feels temporary, even if it isn't. On screen, affordability doesn't reset quickly when rates stay high. Now the other side, why sellers won't sell? Millions of homeowners are sitting on low mortgage rates from the last cycle. If they sell and move today, they often have to swap that cheap rate for a much higher one. So even if they want to move, for job, family, lifestyle, the payment shock makes them hesitate. This is the lock-in effect. Sellers don't list, inventory stays tight. Prices don't fall the way people expect. Buyers stay frustrated, and the market stays frozen. It's not that nobody wants to move, it's that the system makes moving expensive. On screen, lock-in effect, low inventory, no normal correction. Here's where most housing videos stop. Rates are high. But the real question is, why do they stay high longer than people expect? Zoom out, the system is dealing with inflation pressure and supply-side shocks, and one underrated driver is global trade friction. Now, when trade is disrupted, tariffs, rerouted supply chains, slower efficiency, costs can stay sticky. Sticky costs can mean sticky inflation. Sticky inflation pushes central banks to keep policy tight. That's the chain reaction. Trade friction, supply chain costs, inflation pressure, higher for longer rates, housing freeze. This is why the housing cycle can get trapped, not because one number is high, but because the forces behind it don't unwind quickly. This aligns with the core storyline you already positioned in your video description. Tariffs triggering a domino through supply chains, inflation pressure, and elevated rates freezing housing activity into 2026. Source. Now, the most important part, what actually unfreezes housing? There are only a few realistic paths. Path A, rates fall meaningfully. If rates drop enough, buyers requalify, demand returns, volume returns. Path B, prices correct enough without rates falling. This is harder when inventory is tight. Sellers can resist, and affordability may still not improve enough. Path C, income catches up. This takes time, and if inflation stays sticky, wage gains don't always translate to affordability gains. Path D, forced inventory. This is the crash scenario people talk about. Layoffs, distressed selling, forced moves. But without that forced supply, the market can remain stuck rather than collapsing. So if you're waiting for a classic crash, the freeze scenario is why that crash may never arrive in the way people imagine, and why this can drag into 2026. Let's make this practical. If you're renting, the advantage is flexibility. Don't underestimate optionality in a frozen market. If you're trying to buy, your edge is preparation, down payment, strength, credit, and patience. You don't need to time the bottom. You need to avoid a bad payment. If you're a homeowner, the lock-in effect can protect you from chaos, but it can also trap you. Plan moves carefully. Job changes, family changes, and future refinancing. Keep this part calm, helpful, not preachy. A common question is, why don't builders just cut prices and fix the market? The reality is that builders are also part of the freeze. Their costs are already locked in: land, labor, materials, and financing. If builders cut prices aggressively, their margins can turn negative. So instead of dropping prices, they usually offer incentives, buy down mortgage rates, or slow down new construction. The result is important. Supply doesn't suddenly flood the market, and the freeze stays in place. On screen, builders slow supply, they don't crash prices. In a frozen market, the most common strategy is, I'll just wait. Waiting feels logical, but it comes with hidden costs. Rent payments continue. Down payment targets move with inflation. And mentally, people get stuck in decision fatigue. The most dangerous part of a freeze is that nothing breaks, but time quietly passes. The market doesn't punish you fast. It drains you slowly. On screen, a freeze doesn't hurt fast. It erodes slowly. You'll notice one year keeps coming up. 2026. This isn't just economics, it's psychology. 2026 has become an anchor. People expect that by then, rates will normalize, the economy will stabilize, or policy will finally pivot. When everyone waits for the same future moment, activity in the present slows even more. This creates a self-reinforcing freeze. People don't move because next year might be better. And when everyone waits, the market stays stuck. So the real risk isn't whether housing crashes or not. The real risk is waiting for the wrong signal. A freeze isn't loud. There are no dramatic headlines, no panic, just fewer options, slowly. And the people who understand the freeze early don't wait for headlines. They position quietly. One more thing to understand about a frozen market. Headlines become misleading. You'll see headlines like prices up year over year or housing remains resilient. But those numbers are often based on very low transaction volume. When only a small number of homes trade, prices don't represent the full market. A freeze can look healthy in statistics while real activity underneath is weak. So the danger isn't bad news, it's incomplete information. On screen, low volume, powerful cars, noisy data. So the housing market isn't just expensive, it's structurally stuck. A freeze can last longer than anyone expects. If you want, in the next video I can break down 3 concrete signals that would tell us the freeze is finally ending. If that would help, comment the prompt word unfreeze, and I'll make that follow-up.